I'm your host, Henri Arslanian, and welcome to the Future of Money podcast. My goal with this podcast is very simple. It's to go deep in some of the biggest ideas, trends, and developments we are seeing in the field of crypto, and hopefully empower you with this information and then let you make your own decision on what their impact could be on the future of money and finance. To do this, I invite each week one of the leading figures of the global crypto community to have a one-on-one conversation amongst crypto aficionados and discuss some of these topics. Before I introduce my guest today, I really want to thank the over 500,000 of you who follow me every week on my various social media channels, from LinkedIn and Twitter to the various YouTube channels that we have now in 5 languages, for really all your support for this podcast. We have now listeners in over 100 countries, thousands of dollars in each episode, and I really thank you from the bottom of my heart for all the support since we launched this new channel. Again, if you like it, make sure to put a 5-star rating to it to help others discover the show as well. Now let's kick off the show. My guest today is Mark Lamb, the CEO and co-founder of CoinFLEX. One thing you probably don't know about Mark is that he was a pole vaulter in high school. Yes, that sport that you see at the Olympics every year. And something even cooler about Mark is that he knows how to fire spin. Yeah, believe it or not, he learned to do that in London by the Thames. And so next time you see him at a party spinning some fire around, you know that it's Mark. Mark, great to have you with us today at the show.
Great to be here.
Before we jump in, I guess a quick disclaimer for our audience as well. Again, please remember that this podcast reflects my personal views, not that of any organization that I'm involved with, and also that this podcast is for educational purposes only, and really should not be construed as any investment or financial advice of any kind. And also, please note that CoinFLEX is and was a sponsor of some of my educational content across some of my other channels as well. So Mark, let's dive in today. First, before we talk about CoinFLEX, I want to talk about the stablecoin market. I want to talk about flexUSD and some of the developments you are seeing in the space. But I think for the benefit of our audience, could you maybe share a bit more about your background, how CoinFLEX came to be, and your personal story as well?
Yeah, absolutely. So I basically, my entrepreneurial career started out in high school. I had a tech consultancy, which was a small business. It wasn't a scalable startup. But we worked for about 50 different startups and businesses and kind of developed that into a small team. I then moved to London at 18, where I, within about a year, I found crypto. So I learned about Bitcoin back when it was around $7 or $8. And it just seemed like this absolutely fantastic thing. I had been studying different monetary systems, different alternative currencies, what money really was, looking at the history, gold, US dollars, obviously, different reserve currencies over time. And I found Bitcoin, and I found out that there was this attempt to create a decentralized currency. And it seemed very implausible. And then I met a bunch of people in London that were, there was a conference in London, Bitcoin 2012, found out that actually, a lot of my technical concerns were answered at that conference, and basically just got heads down stuck into the industry. I was talking to lots of people that ran exchanges and were trying to set up, different businesses in Bitcoin. There were probably less than 400 people worldwide involved in the industry at that point in time. And I started trading Bitcoin professionally, like as a market maker, effectively. I became 10 to 20% of the UK Bitcoin market pretty quickly, just out of my personal bank account and trading that way, providing liquidity to people OTC. And basically realized that the spreads were very wide. Obviously, it was easy to make money, but the manual effort involved, the market structure was very immature. And if we created an exchange similar to Mt. Gox, but run more professionally, we could create something that actually scaled and really, enabled Bitcoin to take off in the UK. And so I ran that business for several years. We eventually got to majority market share in the British pound Bitcoin market before basically realizing that I'd cornered the wrong market. So GBP to crypto is obviously interesting, but it's not nearly as interesting as futures and some of the more advanced products you can create in crypto, because what crypto really enables is the disintermediation of financial markets. So lots of products that right now are heavily intermediated. What I mean by intermediated is there's lots of middleman involvement. There's lots of involvement from third parties that don't necessarily need to be involved in the process. And what you can create with crypto is a financial market that might be more decentralized or even more centralized, but just with fewer players in the mix. You're going to one player rather than 15 or something. And so that creates a lot less friction, that cuts out a lot of middlemen, and that can create a much, much better environment for consumers. And so that was how I basically spun off from CoinFloor and created CoinFLEX, moved to Hong Kong, and the rest of the story is history, basically.
That's very, very interesting. I mean, have you kept in touch with some of the people from 2012 that were involved in the community back in London?
Yeah, in fact, many of those people are our investors in CoinFLEX. So Roger Ver, Mike Komaransky, and several others who are people that I knew from 2012 are actually heavily involved in the CoinFLEX exchange and as investors and otherwise. And so there's a deep network there. I think a lot of those people tend to be people that are not very public today about their holdings or their involvement in crypto, but are just quietly making moves behind the scenes. And so it is a deep network. I think you've got a lot of people with very common beliefs. The people that got into Bitcoin at that time had certain political beliefs. They had certain technological beliefs, technological prowess. I came into crypto from the perspective and partially of someone who was obsessed with cryptography and a student of cryptography, a user of cryptography, and a user of open source open source computing systems. Big user of Linux, big user of a bunch of different open source software. And so the idea of an open source money was very attractive to me. And I'd never been interested in finance before, and always interested in tech because I just thought, there's so much bureaucracy you can cut out with tech. And the idea of cutting out financial bureaucracy with technology was like, oh man, now I'm interested in finance. So that was kind of my journey in crypto. And part of the discovery process was one of the CoinFloor shareholders was DRW. And DRW Trading is obviously one of the largest high frequency trading firms in the world. They became heavily involved in CoinFloor as a shareholder and market maker. And so I had a very strong relationship there, and that kind of led to a lot of conversations around futures and the nature of futures markets and why physical delivery is better than cash settlement and these types of things. And that ultimately is what led to the creation of flexUSD.
Yeah, I want to talk about flexUSD. Definitely, it's very interesting actually. And one thing you mentioned, Mark, about the initial some of the I think the libertarian movement. I think in the history of crypto, people often I don't think give enough credit to that movement because it had such a big impact in the early days of crypto. And actually, before we talk about CoinFLEX, I remember during those years, I remember when Mount Gox happened in Tokyo. Personally, I really at a time had a very serious doubts whether Bitcoin was going to survive. I mean, at the time it was a big percentage of the global volume. During those eras from 2012, let's say till 2016, 17, was there any period you thought Bitcoin was dead? It was a great experiment, but it failed? Or any time you had doubts on the ecosystem?
I actually gave a speech on Bitcoin in 2012 where I said that even if every single centralized exchange was shut down, Bitcoin would still succeed. So when Mt. Gox, I think everyone that was building things full time in the space was kind of predicting Mt. Gox would collapse about 4 months before the collapse. So I didn't think for a second that it was going to cause a collapse of the crypto ecosystem. But the thing that was scary was how much of my customer base and the global crypto customer base thought that. So even as much as I didn't think it was a terrifying time to be building things in crypto because you just see all this. In 2013 was the most insane year of crypto. Even people today, I think it's kind of hard to find anything comparable because Bitcoin did 100x. The biggest coin, the main coin, did 100x. And so went from kind of $10 to $1,000. And in that time period, the people, I remember that there was a party with Bitfury and all these events, and the people that were in the space, everyone just thought, well, next year, 2 years from now, 3 years from now, this is going to replace the dollar. It wasn't like, oh yeah, we've got 20 years to go, 30 years to go. It was like victory is imminent. And so it was this interesting time. And you kind of went from way parabolically overzealous expectations on the upside in 2013 to drastically the exact up. Everyone just thought, oh, this is dead. This is basically failed. And the fact that it didn't actually inspired a lot of confidence in people. And I think that was that, obviously there were previous cycles and previous waves. And my first wave where I got scared was the crash from 130 to $90. But after that wave, I'd never sold any coins out of fear. And basically, it just enabled a lot of people to build that 2014, 2015 period. If you'd stayed committed to crypto at that point, everyone knew it, and everyone knew that this was never going away. And there's a big move against it. A lot of people were trying to do these blockchain distributed ledger technology businesses rather than be crypto businesses. But if you'd stuck with it, the gains from that were just absolutely incredible. So
it was the era of a blockchain, not Bitcoin, right? It was those conversations. So can you tell us, before we talk about, I definitely want to cover about flexUSD, but can you please tell us maybe for our audience, what is CoinFLEX and what is the purpose and how it is used today?
Yeah, so CoinFLEX is the home of crypto yield. We've created a yield platform where users can earn yield on their dollars or their crypto in a number of different ways. And the thing that the yield products have in common is they give 90 to 100% of the returns to the user directly. And the returns from these yield products are all direct from the market. So there's no abstraction. Again, it's going back to this thesis around disintermediating and removing middleman from financial markets. These are yield products that give the returns to the user, and the returns are directly sourced, directly tapping into the market. And this is kind of our thesis around crypto yield 2.0. With 1.0, you had all these products that say, oh, we'll pay you 8% on your dollars or your Bitcoin or whatever, and you don't really know where the yield's coming from. With crypto 2.0, I think there's kind of two sides to it. One, on the DeFi side, there's a bunch of things that are extremely transparent. And on the CeFi side, I think we're completely transparent about the source of these yields and also the scalability of them. And users have benefited enormously from that. But the other thing that CoinFLEX is a futures exchange. And that's where the yield's coming from. So people don't understand that actually when you go to other platforms in crypto that pay interest, a lot of that interest is coming from futures markets. And so, those platforms might be users of those futures markets themselves, and you might not know which ones they're using. And so the risk is really obfuscated and really unknown. But with CoinFLEX, it's all in one business. It's all one clean structure. And so CoinFLEX is two things. It's a yield platform and a futures exchange. And that's what we do.
Awesome. Let's talk about the yield platform. I think because that's very, very interesting. And one thing I think you guys have, which I find very interesting, is this the flexUSD. Maybe can you share with our audience what is flexUSD and how is it different from other stablecoins you see in the market today?
Yeah, so flexUSD is the only interest-earning stablecoin. So what I mean by that is, well, what's a stablecoin? So a stablecoin is a token in crypto that's always worth $1. Simple enough. Now, the mechanism to be worth $1 is really important. The ideal mechanism is just creatability and redeemability. At CoinFLEX, you can go in, you can mint or create new flexUSD using USDC 1-to-1 without any fees. And you can similarly go the opposite way. So you can redeem 1-to-1 without any fees for USDC. And so that fulfills the first function. But the second function is where we separate ourselves from all the other players. flexUSD pays interest. And what I mean by that is not you can stake it in some product of CoinFLEX's that pays interest, or you can stake it in a DeFi thing that pays interest, but actually flexUSD, holding flexUSD in your wallet pays interest. Holding USDC in your wallet or on an exchange pays no interest. So Tether, USDC, DAI, every single UST, every single other stablecoin has an interest rate of 0. And this is similar, if you think about it, to a bank interest rate, Fed funds interest rate, or a bank rate. There's a value in society for having an interest rate paid on idle funds. And I say idle funds, not products. So treasuries, there's lots of fixed income products in the land of fixed income, but you can lose money on treasuries. If treasuries are not guaranteed, they're only guaranteed to be profitable if you hold them to maturity. But if you buy a treasury and then yields go up means price goes down. So if you then sell it a month later and the yield has gone up, the interest rate has changed, the macro environment has changed, you're actually losing out. So you're actually, you're going to sell that thing for less than the price that you bought it at. And so that's where there is such a thing as a bank rate and a Fed funds rate, and the rate that dollars just earn in the bank. And CoinFLEX is trying to create that equivalent for the stablecoin world. So especially if interest rates rise, people want something that pays interest. They want something where while they're using their capital, while they're holding dollars, and instead of holding in a bank and earning 0.5% or 0.7%, they can earn it, they can hold it on the blockchain and earn flexUSD rates, which are kind of 5 to 20% depending on, the market at the moment.
And just to clarify, when the interest is paid, it goes into their CoinFLEX account, I presume? Like it's when they're holding the flexUSD?
Yeah, so if you're holding flexUSD on CoinFLEX, it goes into your CoinFLEX account as just a growing flexUSD balance. If you're holding it on Ledger or Trezor or MetaMask or some external wallet, it also goes into your own address. So it just your balance goes up.
So, one thing, Mark, that you mentioned before is that obviously you're providing a lot of transparency, but also giving back to users, right? And this is something, a theme that we're seeing more and more about, this kind of transparency. It reminds me of the days of Vanguard and what Vanguard tried to do in the ETF world, where they try to give back to the users, right? Do you think this trend of really giving back to users and basically the fees that are eliminated by the middleman and actually giving back to users is a trend that we'll see more and more in crypto, especially when it comes to yield products?
Yeah, absolutely. I think initially you had a bunch of stablecoins come out where, hey, I don't care if it pays no interest because I'm getting this extra functionality on my dollars. My dollars in a bank can't be programmable. They can't be sent around the world. They can't do all these things that stablecoins can do because they're on a blockchain. But when you change that into a world where stablecoins are actually well adopted, all of a sudden it starts to be like, okay, well, this stablecoin, Tether has a 10 basis point redemption fee. Okay, maybe some of the usage starts migrating to USDC, which is free to create and redeem. And then you look at interest, and all of a sudden there's a comparison of quality of stablecoins, and as that market proliferates, more funds go into the stablecoins that actually have positive traits. So I think it's similar for yield platforms as well, where obviously if you look at the yield platforms at first glance, they all kind of look the same. But then when you look under the hood, who's taking what kind of risks? Are those risks disclosed? Are they apparent to people? One of the powerful things, we're going live with this in a week or two, is that flexUSD is going to be audited by a large auditing firm in the US. And there's going to be basically 3 times a day attestations of the balance sheet of flexUSD. As a stablecoin, that's pretty common. But comparing it to yield products, no one else is doing that. And even as a stablecoin, every other attestation is pretty much monthly or quarterly. So this is the most frequently audited or attested to stablecoin, with also, if you compare it to yield products, what other yield product in crypto actually has attestations from an auditing firm? This is a level of transparency that almost no other players have, if not no other players have. And so we're really trying to lead the charge, and we're also trying to be integrated all into one, single product. The yield part of the business, the stablecoin part of the business, and the exchange are all one business, and you get a huge economy of scale from that all being integrated into one platform.
And it's very interesting because you're right. They are now attestation programs for all the big stablecoins. We'll talk about that in a second. But I think what you guys are offering from this perspective, from what I understand, is more kind of a yield platform, right? So it's very different from that perspective. Mark, there's been obviously a lot of these yield platforms now that have sprung up over the last couple of years. But also the levels of yield they provide varies a lot from one platform to the other. And there's obviously a lot of murkiness often of how the yields are generated. One question I get a lot from a lot of my followers is that how are these platforms able to generate this yield? Can you maybe share with us how some of these platforms are generating yield in the market and how what you guys are doing is different from what we may see in the market today?
Yeah, absolutely. So if you think about crypto and you think about why is there a yield on dollars in crypto, it's really there's demand for leverage. So leverage and lending can come in many forms. And you can have things that more traditionally represent a credit card loan. So in a credit card loan type transaction or a small business loan or something like that, I'm lending money to Joe, and Joe can take that money and he can do great things with it, or he can do terrible things with it and not pay me back. And actually some platforms are doing that. They are effectively taking counterparty risk to some third party company, hopefully who's a very good credit risk, but they have that risk that the borrower runs off with the funds. The other type of lending is more akin to a housing mortgage. And if you think about a mortgage, in a mortgage, the bank has very little risk because if the borrower stops paying, the bank can take the collateral, they can just take the house and sell it. And so as long as the value of the house is pretty liquid, they're okay. Now, crypto is even better than this because a house takes a month, 3 months, maybe even 6 months to sell. But I can sell crypto instantly, right? Even in large size. You can get 1 million done in a matter of seconds or a minute. You can get tens of millions or 100 million done within an hour or within half an hour or even within 10 minutes. And so this makes crypto far superior to houses from a collateral management perspective and from a liquidation perspective and from a lender's perspective. And flexUSD is ultimately lending into these futures markets. It's lending in a collateralized way. So it's not taking the risk that someone runs away with the funds or someone does something stupid with the funds. It's basically saying, look, if I'm going to lend you $1, you need to give me $1.50 worth of Bitcoin or something like that. And I'm going to remargin you in real time such that you're always over collateralized. And it's not doing this via salespeople and OTC, arrangements between companies that have to be manually policed. It's doing this on a marketplace, a live, electronic, 24/7, 365 updating marketplace, which is CoinFLEX's futures market. So rather than have it be separate and I'm lending you these physical USDCs or these dollars, and I'm physically taking these Bitcoins, it's all managed algorithmically on an exchange, on a market that's completely open and transparent to everyone. And we call this repo. Repo is a technical term. Futures are even a technical term. Not everyone has to understand how they work. But the thing people can understand if they want to understand flexUSD is the yield is coming from something similar to a housing mortgage, but with real-time monitoring and with crypto as the collateral instead of the house.
I think it's a good way, and at least, I think what I love about a crypto yield program like yourselves is actually providing transparency on it. Often, with one topic we discuss is some of the big asset managers, the BlackRocks or the others who do actually stock borrow lending, for example, but that actually goes to shareholders, doesn't go to the people who are buying the ETFs and other products as well. I think it's a very interesting development from that perspective. Mark, I want to talk about yields, right? So obviously today the yields, even on holding, US dollars in stablecoins, are actually quite high compared to traditional markets, right? It's almost zero at the bank, whereas I can get almost double digit in the crypto space. What do you think is the future of yield on stablecoins in the crypto ecosystem? Should we expect yields to go down? And what would be the catalyst that will make the yields go down when it comes to crypto stablecoins?
Yeah, so it's a great question. And I think the real question is, why isn't this market 10 times, 100 times bigger? Because obviously the yields are quite good. But I think the transparency is low and the trust is low, and we're trying to solve that problem. But at the end of the day, who's demanding this leverage? Who's paying these rates? And what's their capacity to pay more? If the market went from what it is now, maybe tens of billions to hundreds of billions or trillions, what does that do to the yield? Does the yield go to 1% or something? And I think the answer is, well, you have to look at comparables. So the biggest comparable is, as you said, stock borrow lending, right? So institutions borrow dollars against their stocks to be leveraged long, to borrow against them, to take, kind of cross-collateralized risk, to do prime brokering, to do all sorts of things. Hedge funds do this, etc. And then also people are trading derivatives on stocks. So they trade ES futures, which is a futures contract on a broad-based index of all the stocks in America, and other types of this. And all of this as a combination, the leverage in equities, the leverage in the stock market is about 50% of the market cap of the stock market. So 50% of stocks are borrowed against, or 50% are synthetically borrowed against. That number for crypto is 1%. So the room to expand this market is at least 50x if crypto doesn't grow from a dollar perspective. And that would be, hundreds of billions of dollars, if not $1 trillion. And so that's kind of where we see the demand side going. The supply side really, I think, needs to lead, because right now what's been happening is you've had times where leverage increases, right? Some group of hedge funds, some group of retail traders, whoever it may be, buys hundreds of millions of dollars, billions of dollars collectively of futures contracts on Binance. And then the adjustable rates, the perp funding rates, the rates that they pay of interest go to 100% annualized. And the problem with that is twofold. One, if you're a retail investor, you have no way to capture that rate. While the rates are 100%, Binance's savings product is maybe paying 10, right? So that's one problem. Second problem is, so on that note, only algo trading firms and hedge funds and prop trading firms that have dollars available are capturing that rate. Everyone else, not able to capture it. flexUSD solves that problem. But the second problem is when your funding cost is 100%, even if you're right directionally, crypto you think is going to go up, you're betting by buying futures contracts as a hedge fund or as a retail trader that crypto is going to go up, you're long, crypto goes up, you have to outperform 100% annualized in order to make any money. So we call that, getting burned down. It's an effect where you say, okay, I'm not going to do this again, because the last time I thought Bitcoin was going to go up, it went from 40K to 50K, but it did it so slowly, or it did it with a lot of chop in between, that on funding, I actually paid more than I made. Or I got, I made a bit, but I didn't make nearly as much as I should have. And especially if you're a hedge fund, you see 100% cost on financing that position, and you're like, no. In fact, you might even see a 10% or 20% cost on financing that position and be like, heck no. So this is what we think is the thing that needs to lead the market next time around, is these guys are burned. The derivatives guys, the people that are being levered and taking out these, large levered positions, many of whom are well-capitalized actors that actually are in a business of taking these directional levered positions. I'm not talking about retail traders. I'm talking about the institutional hedge funds that want to be making these directional bets. These guys are burned, and they're all burned. And the way to fix this is to create a market structure where, if flexUSD got to 10 billion, if flexUSD got to 50 billion, these guys have an environment now that they can play in. They have a product, which is our futures contracts, that they can say, oh, we can scalably take a $300 million 3x or 2x leverage position and manage that efficiently as a derivative rather than spot. And we're comfortable paying the 5 to 10% interest rate because we know it's not going to blow out to 100.
Yeah, absolutely. It's interesting what you mentioned, because we are allowing everyday people in a way to get exposure to this in a way that would not be possible, frankly. But today, quant funds, hedge funds are able to get this alpha and obviously now you're able to give that in a way to a certain extent to everyday people as well. But one thing, Mark, I want to touch upon is basically, obviously, platforms like yours are promoting transparency and accountability, and to the public and to users as well. What do you think is going to be the your competitor of the future? What do you think is going to be who do you think will be the competitors of the future of yield platform? Would it be, again, other centralized platforms that provide as much transparency, or will it be DeFi? Do you think one day users will go on DeFi platforms, and that could be a big competitor to platforms like yourself?
I think it's definitely going to be both, and I think it's actually infinitely healthier for the crypto ecosystem that it is both. Because the thing about crypto that is so fascinating is it is a playground with which you can create very, very interesting products. And so, I'm sitting here in Dubai. We're a global business. We have entities all over the world. We're launching CoinFLEX in the US, which is going to be regulated in America. You can have a market structure where there's a few different regulatory environments that you can, take from the best of each. Similarly, with DeFi, you can do the same thing, but with blockchains. And the end user is the biggest beneficiary. Because if CeFi platforms are lazy or not competing well, they can go to the DeFi land. And if DeFi is, lots of rug pulls and dangerous smart contracts, they can go to CeFi. And so that's a structure where the end consumer massively wins. And we're excited about that. We want to play in that type of environment. We want to compete because we think we can win. And the area we think we can win on is that ultimately leverage is best managed in a centralized way. So there's a lot of benefits of DeFi, lower counterparty risk, all sorts of things like that. But the largest positions in crypto, if you're talking about users that have 9-figure positions and collectively users that have $10 billion of positions, those collective positions are dangerous to manage in DeFi, because in DeFi, everything has to be fully public and fully open source. And in CeFi, you can have a degree of manual intervention in markets. You can have a degree of nuance there that is sometimes needed. You may, in high risk environments, you may have to do certain things to backstop liquidity to manage risk. And so, and it's just easier. It's easier to manage real-time liquidations when you're not constrained by blockchain speeds. The times in which blockchains are slow is usually the exact same times when you need to manage liquidations quickly.
And I think it's a very interesting point. This is why I think that there'll always be in need of centralized platforms, especially for kind of the OTC or for some of the institutional market as well. Mark, we're already out of time, but there's two other questions I want to ask. This is super interesting, and I just want to make sure we make time for it. One of them is on flexUSD uses USDC. What do you see the market of US dollar stablecoins? Of course, in the market we have USDT, we have USDC, we have UST, and we have many others. And obviously today, Tether, USDT, is about 65% of trading pairs and a large chunk of the global volumes. How do you see the landscape? Do you believe the usage of USDC will increase because it's regulated, more transparent, or USDT will continue its dominant position? What are your thoughts on that point?
So I actually think there's a very boring reason as to why USDC is going to continue to outpace Tether in growth. Tether costs 10 basis points to create and redeem. If you, I'm sorry, Tether, but it's true. There are no exceptions to this. They don't make any, contrary to belief, if you're in a huge exchange, you don't get any concessions. And so Tether has a charge. USDC doesn't. That is extremely attractive. Stablecoins are a business where the stablecoin company really should make all the money from the yield and not from creation redemption fees. And when one has heavy fees and the other one has no fees, that's a very basic one. The other one is that Tether isn't accessible directly, as in you can't directly create and redeem by Americans and American companies, and USDC is. And so And that's been both a big thing holding flexUSD back and a big thing that I think is going to lead to a lot of flexUSD growth over the course of the next 12 months is that flexUSD will soon be in the same category as USDC. You'll be able to create and redeem it as an American company or individual for free with bank account funds. And so that's a huge advantage. Both of those are huge advantages that USDC has over Tether. I think going beyond that, there's just a whole ecosystem out there of stablecoins. Some have huge risks associated with them. Some are drastically less risky and also maybe less interesting. But yeah, it's an amazing market. You know, the stablecoin market, I think, is the portion of crypto that I have the most conviction will grow, you know, vastly over the next few years.
And also for other use cases, right, from cross-border payments and others. I mean, I personally, whenever I do cross-border payments now, I just use stablecoins. And even for keeping, I don't keep money in bank accounts anymore for that simple reason. One thing I want to discuss, Mark, is also the regulations, right? You just mentioned right now that obviously flexUSD is looking at flexUSD is looking at regulations in the US. I mean, to what extent, what do you think will be the impact of regulations on crypto lending platforms? We saw, for example, BlockFi get into some skirmishes with some of the regulatory bodies in the US. Coinbase was not able to launch its platform based on pressure as well. How do you see the regulatory landscape, especially in the US, with regards to yield products?
Yeah, so this is at the end of the day why we've launched flexUSD in the US, or we're launching flexUSD in the US and not our other product, the AMM Plus, because obviously we want to go into markets and we want to go into products where there's clarity. You know, as an entrepreneur, you're building in the space, clarity and clear, regulatory frameworks or friendliness at least is what you're most interested in. And so the US has a high degree of clarity and a high degree of friendliness towards stablecoins. We've seen that with Biden's remarks. We've seen that with the Fed's recent pronouncements. They don't have that with regards to yield platforms. And so, you know, I say CoinFLEX is a yield platform, but in the US, CoinFLEX is an exchange and a flexUSD minting and redeeming facility. And so, you know, that's kind of how we see it. And I think, you know, players that are trying to operate, yield platforms, borrow lend platforms in the US are going to face the issue that there's not a clear understanding of what your product is, how your product should be regulated. And even though I think a lot of these entrepreneurs want to have their products regulated, the guidelines are just not very clear. And so that makes it very difficult to launch those types of products in America. You know, our business is entirely non-American. And so, you know, we're going into that market with the product that has the clearest regulatory positioning. But with the other products, we're just reserving those for our international customer base because it's not clear yet. And I hope that changes over time. I think the powerful thing about Biden's executive order, it is calling for a unified regulatory front. There's going into the US as a US business, there's over 60 regulatory authorities that you have to liaise with or you're indirectly or directly responsible to. That's a lot. I mean, you know, most countries it's one, maybe two. And obviously the US is a big market. The structure of the United States, where states have their own authority, you know, there's some differences there, but having more of a unified approach will make it much easier for entrepreneurs to build. And I talk about building, but I mean for anything, you know, whether it's yield or something else.
My producer's going to kill me. I want to ask one more question before we launch on the fire round question. This is super interesting. I want to make sure I get this question in. Obviously, you mentioned Biden's executive order. In there, they talk about a US dollar, a central bank digital currency, right? What do you think will be the impact on US dollar stablecoins if and when we have a US CBDC? Do you think then they will coexist next to each other, or we will see gradual decline of US dollar stablecoins?
Well, I think the Fed seems very reticent to create a CBDC that's directly usable by a retail or by anyone that isn't a bank. And they have that mentality because they don't want to hurt credit disintermediation, which they view as the bank's main role. And so by launching a CBDC that is directly usable via retail and non-bank institutions, it creates this competitive dynamic between the Fed and its banking members. And so I think that is the biggest conflict there. if they did, I think there's still a role for privately issued stablecoins, because obviously there might not be as much a role for Tether and USDC because the Fed's coin is going to have way less counterparty risk, but there's definitely a role for flexUSD because obviously there's a huge interest rate associated with flexUSD, and so you want something that's both usable on a blockchain but also pays interest.
Well, thank you, Mark. This was super interesting. We're going to go quickly to the 5-round question. My bell is with me, so I'm going to ask quick questions, and I need 1 or 2 word quick answers, and the bell is here to keep us honest. Are you ready?
Ready.
Let's rock and roll. If you had to give an advice to a student today, what is the one course you recommend every student takes today that you wish you had taken?
Learn about crypto financial markets.
There you go, crypto financial markets. Mark, you've been in crypto since 2012. If you had to take a bet on who is Satoshi, is it a man, a woman, or what country he or she is from, what would be your bet?
Nick Szabo.
Oh, yeah, here you go. Nick Szabo, yeah. Many people believe in that as well. What's your favorite crypto company, a part of the ones you've launched? What is the one crypto company you admire a lot?
It's a tough choice between Tether and Circle.
Oh, good one. Curious that. It's an interesting choice. Why Tether and why Circle? Quickly, why would either of them?
I think Tether took a huge risk at a time when no one knew whether stablecoins were going to be. I mean, no one. They invented the term stablecoins, but they took a huge. I remember being with Brock when they were creating Tether, and he was like, "Yeah, we're going to create this thing called Real Coin. It's going to be worth $1." I was like, "There's no way. How is that going to be? How is that going to be regulated? How is that possible?" And I think they leapt forward and ushered in kind of an era of a new industry. And I think USDC has kind of done something similar. And so I have huge respect for them. Yeah.
So you live now in Dubai. What is your favorite thing to do in Dubai?
There's so many great crypto people here, so many great restaurants here. It's such a thriving crypto scene here. I think Dubai's done a great thing by attracting so much amazing crypto talent.
Absolutely. Well, that's where I'm spending a lot of my time as well. Talking about that, actually, I remember last time, Mark, I saw you was on a basketball court in Hong Kong. You spent a lot of time in Hong Kong. What was your favorite thing to do in Hong Kong?
I mean, hiking and the beach and nature, again, with crypto friends. So, I mean, Hong Kong's just a beautiful city. So much nature accessible to such a vibrant, bustling, skyscraper-filled city. So, yeah.
Mark, you mentioned you were a pole vaulter in high school. What should people do if they're interested in pole vaulting, and where can they find more about it?
Anywhere. I mean, unfortunately, it really seems to be only available if you're growing up. But anywhere you can, any track and field program that has it, just grab a pole and try to stick it in the ground and jump over, the bars. So,
Mark, if you're not in crypto, what other industry would you want to be in if you're not in crypto?
I've been in crypto a decade, and it's so hard to envision myself in any other industry, but probably some part of the technology industry that enables people to be more free. Ideally with open source software, or ideally with the intersection between technology and some other field. So.
This is a common answer I get from a lot of people in crypto. They're like, it's crypto, nothing. That's it. This is our life, And last question, Mark, again, thank you for today, was if you could have lunch or dinner with one person, dead or alive. If you could have lunch or dinner with one person, dead or alive, who would it be?
I'm going to give the boring answer and say Elon Musk.
Here we go. That's a very common answer as well. Well, Mark, thanks for being with us. That was Mark Lamb, the co-founder and CEO of CoinFLEX. Mark, where can people find out more about you or what the business you're building?
Yeah, so you can go to coinflex.com is the Twitter handle. Mark David Lamb is my handle on basically every social platform. Coinflex.com is our URL, and coinflex.us as well, both on Twitter and online.
That's awesome. Well, thank you very much, everybody, for being with us again. Thank you for all the listeners again for joining this other show. I know it went a bit longer than normal, but I think it was so interesting. I really want to make sure we were able to really go in depth in some of the topics we discussed. If you like the show, please make sure to click subscribe and give us a 5-star rating. It really helps us. It helps new people discover the show. If you want to stay on top of the latest developments on crypto and the future of money, make sure to follow me on LinkedIn, Twitter, and also for our newsletter, and also on our YouTube channels as well, where I have a lot of my previous interviews, including the one with Mark, will be on as well. And again, remember that now all my YouTube channels are available not only in English, but also in French, Spanish, Arabic, and Mandarin Chinese as well. And also, if you have friends that want to learn about crypto, make sure to check out my latest online course called Introduction to Bitcoin and Crypto on the Udemy platform, where I explain in 90 minutes all the latest global trends and essentials that people need to know about Bitcoin, Ethereum, stablecoins, DeFi, CBDCs, Web3, Metaverse, and many, many other topics. So hopefully that can be a useful gift as we hit the birthday season and some of the other holidays as well. So thank you everybody for joining us today. Thank you, Mark, for being with us on this episode of the Future of Money podcast, and see you all next time.